Well, hello there. Welcome to our levered ETF series. In this video, we are going to be covering the 2X Long Levered Energy ETF. Before we just jump into it, we need to cover what an ETF is, just in case someone here doesn't know what an ETF is. Let's go really quickly through an ETF, and then we'll jump into the 2X Energy ETF. Whenever you hear the term the stock market, that really doesn't mean anything. Look, there's several different exchanges where stocks are bought and sold on a daily basis and they go up and down. There's really no way to say, hey, how are all the stocks doing? And so they created these things called indexes that you could actually track what the market was doing, like the Dow Jones Industrial Average, the Standard & Poor's 500, the Russell 2000. And they created these as a way for someone to look at this number and say, oh, the market went up today, the market went down today, but it was just a collection of those 500 stocks that they put in there. In 1993, a firm called State Street created the first exchange-traded fund called the SPY, or as was called the Spiders. This was developed to deliver the same return as the S&P 500 index. The great thing about these is it was a stock. It wasn't a mutual fund. It wasn't index. It could be directly bought and sold like a stock at any time at a really cheap price. This was a great alternative to mutual funds. Before ETFs, if you wanted to get the same return as the market, you had to pay a company probably somewhere around 0.5% or 1% to run the money to try to get you the same return. Now it's as easy as just buying SPY. And these have options, which is awesome. We're an options trading firm at Maverick, so we absolutely love options on these ETFs. So the first thing we need to talk about is the IXE. Now, what the IXE is, this is the Energy Select Sector Index. Now, remember, an index, you can't buy it. It doesn't exist. It's simply a figment of someone's imagination. However, this is the index that the ETF is trying to track. If somebody wanted to trade the IXE, but get a little bit more of a multiplier out of it, they would simply multiply times 2, and this would give them the ticker symbol ERX. The ERX is the ticker symbol for the Direxion, 2 times energy financial long. Now, this ETF will attempt to deliver the same return of the Energy Select Sector Index times 2. Now, the way they do that is they're not out there buying stock like 1X ETFs. They're buying futures, options, derivatives, some stock, but basically they're trying to get it to where their symbol matches 2 times the return of the IXM. Now, you can see on this one, there's a lot of concentration in 2 names. Take a look at Exxon and Chevron. That accounts for about 44% of the entire ETF. That's a really big weighting here on this ERX. What I want to do is I want to take a look at IXE and ERX side by side. Now, first off, if you're going to look for the symbol for the IXE, I've seen it written several different ways. IXE, some software takes. Some is $IXE, telling it it's an index. And I've even seen some software programs use SIXE as the ticker symbol for this. Once you find that symbol, you can stack these up side by side. So we've got the IXE on the left, the ERX on the right, and I'm just going to play them and you'll see that they basically are doing the exact same thing. The ERX is attempting to get 2 times the return of the IXE. And you can see here, for the most part, it tracks side by side. Before 2020, the ERX used to be a 3-time levered energy ETF. However, COVID hit, and there had already been several wipeouts. Now, what I mean by wipeouts is that understand when there's a big move in the markets, let's say there was a 35% move down. If you take that times 3, that is about a 98-99% losses. And there's already been multiple wipeouts of symbols in energy, in nat gas, in gold and silver. There was already a lot of times in the past where these ETFs lost 100% of their value. So Direxion decided, hey, you know what? It's a little bit too much. We don't want to see people get wiped out. They changed 10 ETFs after COVID from 3X to 2X. And the ERX was one of them that was downgraded to a 2 times return. As you can see, these have some risk to them. Like I said, these got completely wiped out several times over from 2015 to 2020. So let's talk about how and when to trade ERX safely. Now, we do like these leverage ETFs as short-term trading vehicles. So basically, it's directional trading. They're a stock, so you simply buy the stock. If it goes up, you make money. If it goes down, you lose money. Very, very simple. Let's take a look at an example of using it as a short-term trade. Let's take a look at making a short little swing trade here on ERX. Now, I am on TradingView, and I'm going to be using the bar replay feature. So if I come here, I hit the replay button, and what I like to do is I like to go back in the past and just pull a random moment and just click on it. There you go. There is the random moment. So we are all the way back in 2021. And at this point, I will simply press play. Now, what I'm looking for is I'm looking for a nice strong uptrend. As you can see, we just had a really large move over the last month. We're probably going to get a pullback or some sort of base. I want to be a buyer of that pullback or a base. So let's just fast forward a couple more candles, see what happens. Okay, we're getting now more basing price action. No, now we're getting more of a pullback. What I want to do is I think this pullback is going to bring it back into this probably 21, 25 area to 22. So this is the area that I'm going to be looking for as an active buy point for this. Who knows if it'll get there? We're getting a nice little doji here. Let's see what happens. Okay, it's coming down into our area. Hit that area. Give us a nice reversal. So at this point, I'm looking to be a buyer here on this one. So let's just put in, we're long here at 23.68. And of course, every single order you put in has to have some sort of protective order. So you're going to put in, if you're using stop orders, you're going to use a stop order. And we're going to put in a stop right below this last swing low at 21.71. All right, now look, we have no idea what's going to happen on this trade. It could go up, it could go down, but we've decided at 21.80 we are out. Regardless, we'll take our lumps and we'll move on. Now, the other thing we need to determine before the trade is even made is how long are we going to hold this for? Now, look, I called for a swing trade. For a swing trade, it means that I'm going to be in this thing for 2 to 10 days. I need a very tight trailing stop. And one of my favorite trailing stops I'm going to throw in is a 9-period EMA. So this is an exponential moving average. And I'm going to be using a 9-period EMA. And it is going to be this blue line here. So I'm going to go ahead and hit play. We'll see what happens to our trade. At this point, we're dragging around here. Okay, so it's already been about 7 or 8 days. It is about break even at the moment. So if you had a time stop saying, I don't want to be in it for longer than 8 days, then you would exit the trade and you would be out. If you have a price stop, we're still there. Our EMA isn't doing anything yet, so we can't use it as a trailing stop. Let's see what happens. The trade, you're still in the trade. We're no longer in the trade. That is a loss. So this trade was a loss on a short-term trade using ERX as a directional trade. As you can see, it acts just like a normal stock. If you go long and it doesn't go up and you lose money. If you go short and it doesn't go down, you lose money. Very, very simple to use them as short-term trading vehicles. Now, I've already talked about some of the risks, and I really want to talk about the risks specifically in ERX because we have seen big moves in the energy sector. We have seen 50% moves lower, 50% moves higher. Remember, times 2, that's a complete wipeout. One of the other risks of these levered ETFs is what's called the return differential. What it means is that, remember, the ERX is attempting to get a 200% return of the underlying IXE. If we take a look at the ERX, this is its monthly return from July of 2020 and August of 2021. So every month, this is the return of the ERX. Here is the return of the IXE. So really, when you're thinking about it, you say, okay, so that top month, July, we lost 0.9%. So the 2 times ETF should lose negative 1.8%. It didn't. It lost more. As you can see here, it lost about 0.5% more. This is called the differential. And if you take a look at the differential just over this year, you can see it was about half and half. Half the months were better, half the months were worse. The ERX is a much better run ETF than a lot of the others. We see up to 5 to 10% differentials on other levered ETFs. This one is actually really close. So hats off to them for running this one really nicely. My guess is that if it was still a 3X ETF, these would be much wider and much more ugly. But for right now, we're still looking at 1 to 2% differences in returns over a monthly period. We have the big risk of just having a leverage ETFs. We have the risk of return differentials. We also have higher fees. These will always have higher fees, and this one's right around 0.95%. Every time you trade this, they are going to charge you a fee for trading it based on how long you held that. And the other thing we don't love about these is there's no options benefit. We're an options trading firm here at Maverick. We love options, and it just doesn't really make any sense. So let's talk specifically about options trading. How do you do options trading on this safely? Well, it's very simple. You don't do it on the levered ETFs. All options trading should be done on the 1X Long Energy ETF, which is the XLE. This is why. If you were looking to buy options, let's say you're looking to buy a call option on the ERX, guess what? It already knows that it's twice as volatile. The options market is very smart. It just simply makes those options twice as expensive. However, because there's not a lot of options trading activity on the ERX, the spreads are going to be wider. You're going to get worse fills, more slippage. It's going to be the same exact trade. Go to where the volume is. Go to where the spreads are less than a nickel on the XLE. And then the last way we like to use these is hedging, and this is where they work wonderfully. Let's talk about how you can use these to hedge. Let's say that there is a trader out there that is short $50,000 worth of energy stock short. So they're short energy, they think energy is going down. But let's say all of a sudden something happened in the world where they're a little bit worried that energy and oil might spike higher. So what they do is they go and hedge. They buy 25,000 of the ERX, giving them twice the return. At this point, they are pretty much hedged. Let's say that some news comes out and oil spikes 10% and energy stocks go up anywhere from 8 to 15%. Big run against them. Now they were short energy stocks. That would have been a big loss. However, they're long 25,000 of the ERX. That's going to go up somewhere around 20%. And so their gain on the ERX is pretty much going to negate or dim their losses on their short stocks. This is a great way to use these as hedging positions on short-term price movement. Before I let you go, we need to talk about the number one risk, position sizing. This energy ETF has been totally wiped out 4 times since 2015. There have been some real boom and bust cycles in the energy market. We saw it in 2016. We saw it again in 2018. We saw it right before COVID in 2020. Then we saw it in COVID when oil went negative. The oil futures went negative. There were complete wipeouts. And so if somebody had their entire portfolio or a large chunk of their portfolio in the long ERX, their portfolio is gone. It's gone. Position sizing is really important on these. They move quickly, they move fast, and they can move very large. You have to have your position sizing correct. So this is how you control the risk on these, is proper position sizing. So how to trade ERX? We like it as a short-term, intraday, or swing trade, a day trade. All that's fine. We just don't want to hold these so long that the differentials become a real headwind for us. Anywhere up to about 15 days, you're probably going to be okay on the differential. And we took a look at the differentials on ERX, and they actually looked really good, really close, maybe 1-2% at the most. Options trading, we love options trading. We love options trading on ETFs, but do all of your options trading on the XLE. That's going to be the Energy 1X Long ETF with the most volume. And hedging, we love it for hedging. It is a great way to go in and quickly hedge out some of your exposure in your portfolio. Well, thank you for joining me. That is the ERX. Happy trading, everyone. Goodbye.